back. It is time now for Sunday Money. Now, over the past few months, several investor lawsuits have made headlines in the Knoxville area. So how can you avoid making bad investments? What are the right questions to ask before writing a check to a financial advisor? Well, our money man, Paul Fain, president of Asset Planning Corporation, is here to join us again with tips to protect your money. So, Paul, is it really, possible to, find out if it's a bad investment? How do you go about doing that? Because stuff can look really shiny and good.
Right, exactly. And, it's not always that easy to sniff something out because, there's bad investments and bad investments. There's a stock you buy that goes down 50%. There's the rental house you buy that, you don't get your money back out of fixing it up. Those are bad investments. Then there's bad investments. Usually behind them are bad people. Think of Bernie Madoff, or more recently in the last year we had the Shapiro character out in California with a couple of promissory note type investments that were actually just a Ponzi scheme. So you've got to apply some common sense. If something says come buy our low risk, safe, high return investment, something's already off.
Yeah.
Low risk, high return.
Almost sounds too good to be true kind of thing.
Absolutely. Absolutely.
And how do these investors get, pulled into bad investments? What's the way they do to attract us and make us be interested,
Well, I think you maybe just touched on it, Leslie.
Yeah.
Our human nature, tends to kick in and take control. So, we want more.
Oh,
so
yeah.
When we
it sounds attractive.
When we hear safer or low risk with higher returns that are above what's actually available, it's going to get our attention. And a lot of this is happening in venues where we're pulled into the free steak dinner or the quote-unquote educational seminar. And it's not that there is never value in those types of events or programs, but let's call them what they are. They're an opportunity to be sold something, and common sense again should prevail.
And how should we go about screening those a little bit better as well? I mean, we kind of mentioned before we came on the show, if it sounds too good to be true, use your gut feeling.
Use your gut absolutely. With an investment, if you can't explain it in 30 to 60 seconds, you probably shouldn't be investing in it. So that's a good rule of thumb. You cannot not do your good research. I mean, look at the company, look at the people behind this investment product. If you're dealing with an advisor, a planner, a broker, do your homework there too. Are they a certified financial planner? Do they work to the fiduciary standard in the best interest of you? And how are they paid? I always want to know how they're paid.
Definitely. All right, really quickly, let's do our fast market fact. Our fast market fact fast.
Yes.
Say that 5 times.
Yes. No way I can. Just to check in on some realistic returns, I checked in with some reliable sources, Charles Schwab, Vanguard, JP Morgan, et cetera, the big financial institution. What are some realistic returns for the next 10 years? And they're a little somber. I mean, if you look at, cash, 2 to 3%, bonds, 4 to 5, 3 to 4%, stocks, not 20%, but maybe 6, 7, 8. That should be the bellwether that you can measure these other programs or sales pitches for, to determine, what it really is low risk, low return, high risk, high return.
Great. Thanks so much, Paul.
Hope
and remember, you can continue to send your questions to Paul as well, and we'll
Yes.
discuss those here on the show.
Please do.